So, if you're anything like me, you've been hearing for a long time the market is overvalued and the market is overpriced. Well, I think most of those people are wrong. And hear me out before you just click away because I'm sounding too optimistic. First, let's take a look at where skeptics have a very good point. This is the Shiller PE ratio. This is looking at the price to earnings of corporations. Remember that the stock market over very long periods of time is mostly based on corporate earnings power. If earnings go up, price should follow. Now, that's over long periods of time. Over short periods of time, there's a lot of other factors at play. A lot of narrative driven speculation happens. A lot of valuations don't matter kind of trading happens. Look at firms like Palantir. They've been trading at 200 times earnings plus for years. And that's just the norm for them. And I'm not here to say that because Palantir trades at a super high valuation, all stocks should. That's a ridiculous thing to say. But a Shiller PE ratio of 40 aligns where the dot-com bubble was. And it's higher than where we were at in 1929, before the Great Depression. So why would I look at this chart and say, maybe it's okay? Well, first, we need to understand that corporate earnings aren't everything. And I think that corporate earnings have become less important over time, specifically in the last 25 years. This chart goes back to the Gilded Age. The time frame of a chart should change our understanding of that chart. Everything from before the 1970s was back when money was based on the gold standard. And so it's hard to compare to today, where money's based mostly on the fiat credit system, where the government just says that money's worth something and we accept that. It's also on the basis of infinite quantitative easing, where central banks are artificially keeping rates low, outsourcing manufacturing to other countries, made goods inflation very low, and the combination of those two things allowed for tons of cheap credit and margin to buy up stocks and create structurally higher price to earnings ratios over time. There's no law that says stocks should trade at 10 times earnings or 20 times earnings or 30 or 40 times earnings. All we're doing is looking at history and saying, what was the average then? And what is it now? If it's higher, then we call it overvalued. And if it's lower, we call it undervalued. But as we've learned, buying cheap stocks may just mean that you own cheap stocks, not that you're investing in something that will outpace the growth of another asset. So let me give you an alternative view. Here is the valuation against profitability metric. And so profitability is just looking at forward profit margins. How profitable are companies? And we can see that since 2000, there has been a dramatic shift of higher PE ratios aligning with higher profitability metrics. I don't believe that this is just correlation. I believe that structurally higher profit margins could lead to structurally higher price to earnings ratios. Let me explain. Before 2000, we really didn't have a software sector. It wasn't the same as it was today. Today's software sector is so different because of the availability of distribution. Distribution was very hard before, and so the marginal cost of doing business, the cost to sell one more unit, was higher than it is today. The lower that cost, and in software companies today, it is incredibly low, which is why any software startup can just make a website and start selling. As long as these profit margins have been rising, so too has the structural price to earnings in that era. And now we're at a point where we're at the highest profit margins we've seen ever. And we're also at one of the highest price to earnings ratios we've seen ever. But the difference between today and 2000 is not just in valuation. You can see today valuations are about the same as they were then on forward PE ratios, but the profitability is so much higher. This is why I don't believe that we're actively in a bubble that's about to collapse. Is there bubble behavior? Absolutely. I'm going to make a video at some point on NVIDIA's circular deals and why I don't think that that's super bubbly, but Circular deals are indicative of some bubble behavior. There's a lot of mania and speculation around AI stocks, and private equity and private credit in particular are in danger town because of their overlending and overzealousness for cheap credit. Now that credit's not so cheap, we're starting to see problems in private markets. But private markets are not the majority of markets, and harm coming to private markets could be a good release valve for some of the steam that's been building up. Take a look at this chart. When we're adjusting forward PE ratios for margins, we see today that a paradigm has shifted since 2000, where the profitability adjusted was above the standard PE metric. Now today, it is far below. In a profitability adjusted metric, price to earnings today are closer to 18 than to 23, and profit margins don't seem to be going down. Nvidia, the world's largest corporation, just had their Q3 earnings and their profit margin was stable, even while they're pumping tons and tons of money into Blackwell, which is very, very capital intensive. Even during this part of the cycle where we should see a decrease in margins, we're not. They're able to keep their margins very high, and so long as that stays where it is, I don't see why valuations should have to come down. Take a look at this. This is the difference between tech margins and the rest of the market. Remember that technology stocks are almost half of the S&P by weight. And I don't just mean technology as a sector. Some of you are like, no, it's closer to 35%. But if you add Google and Meta, Amazon back in, remember, Amazon masquerades as a retailer, but most of their money comes from cloud operations and technology services. But when you add those three companies back in, we're back at 51% of the S&P 500 is functionally big tech companies and software firms. And their margins are incredible. Compared to the margin growth rate of the average corporation, they're doing incredibly well. And they're carrying the market's gross margins in net. Now, for those of you who have been watching the market the last month, you'll know that tech had a big sell-off. This was great because it came at the same time that profit margins were going up and earnings were going up. This reset a lot of price to earnings, and it happened all across the market. Tech re-rated from 31.7 times to 27.2 times in a month. That's a 5% or so drop, but a huge change in valuation. So even if you're looking at these relative valuations, we're still seeing some compression and re-rating going into the end of the year. If we're back at 30 times earnings again by the end of the year, well, we're back to where we were in October, and that could be a 7 or 8% rise in the index from here. Remember that during this time, some of these sectors even re-rated higher. Staples and healthcare actually gained in PE standing during the sell-off because they were bought up partially as a defensive move while their earnings were stagnant or falling. This is another reason why price to earnings isn't everything, and people who just value the market with a price to earnings lens are somewhat myopic in their view. They just don't see all the complexity. There's more going on, and profit margins are just one piece. I'm not claiming to have solved this either. Okay, so what could hurt tech's profit margins? If we're believing my theory that profit margins can lead to a structurally higher price to earnings ratio. And so it would be okay that price to earnings are rising so long as gross margins are also rising. Then what would hurt those gross margins? Well, this is where we enter the actual part of the market that I'm kind of a doomer about, and that is AI. Regardless of the fact that we weren't quite ready as a society to handle the introduction of cheap AI, one of the things that has been bothering me is how low margin AI as a service actually is. What we're seeing is that providing LLMs at prices that people will actually pay for is not profitable. Big tech companies like Google are able to offset these losses because they make a ton of money in advertising, but pure AI companies like OpenAI aren't able to. They lost $5 billion just last quarter, mostly because they're letting people use Sora to generate a bunch of random crap that no one ever wanted to make or wants to consume. YouTube is full of AI slop shorts designed solely to extract attention spans and money from YouTube. It's mostly made by third world creators for third world audiences trying to penetrate into the US audience who largely does not want your AI slop. But if you load a fresh YouTube account, you'll find it in mass. And this stuff isn't profitable for tech companies. That's a problem. Because remember that profit margins justify price to earnings ratios. If we wake up one day and all these tech CEOs start saying, oh, you know what? We didn't make as much money as we thought we were going to. Oh, it turns out running ChatGPT is a low margin business. And so we're really going to be profitable once we get to scale and volume. And when you start hearing that kind of talk, look out below. But maybe I'm being doomer about that too. Look at GPU rental rates. This is how much it costs to run a GPU per hour. They're falling pretty dramatically, and I imagine they'll fall even further when the new Blackwell line comes out from NVIDIA. The hyperscalers are going to be buying all the new chips. They'll sell all of their old chips off, rent them out, and that excess supply will cause prices to come down. So maybe it's low margin now, but high margins later? The jury's still out. Take a look at this. This is token costs. A token in AI is essentially a unit of measure of kind of how much AI we're using. The more tokens you use, the more AI processing power you use up. So it's a good comparative metric of use. We're seeing a huge increase in the amount of tokens that are used. For example, if you input one sentence to ChatGPT and it outputs one paragraph, you spend about 4,000 tokens. What we're seeing is that the average tokens processed is going up dramatically, but the price of consuming those tokens has gone down. In fact, it's basically halved in the last year. This goes along with GPU rental rates, and suddenly all of the costs are going down across the board. We're also seeing a slowdown of token usage in large hyperscalers. Here's Google's token usage. Don't get me wrong, 1.3 quadrillion tokens is a ridiculous number and likely still not profitable for them at all. But Google's token usage is slowing, and that's an important metric to watch. Their demand isn't slowing. We know more people are asking Google for search answers that rely on AI. More people are using the new Nano Banana Pro, which makes incredible images that don't look like traditional AI images. Very scary. But they're using less tokens despite all this. And I think it has a lot to do with efficiency gains. If you're able to produce similar or better outputs for end users while using less tokens overall, that's a good thing. The cost per token goes down, you use less tokens, the cost for GPUs go down, and voila, you're at a high profit margin business. I don't know if that's going to happen, and that's not what I'm predicting per se. But I want us to remember as we go forward in this world and have to make sense of markets, that markets change, paradigms change, and as new technologies emerge, they change the way that business is done. So if you're valuing the market today like you valued it 10 years ago, you may never buy stocks ever again. Because I think that structurally, price to earnings ratios have a new floor, and that floor is higher than it used to be. It relies heavily on profit margins carried by the largest players in the index. And big tech companies running these AIs make up over half of the index, and they have to remain profitable in order to justify those higher PE ratios. If I'm right and AI doesn't turn out to be an incredibly profitable business, it turns out to be a fairly low margin business where all models end up being commodified and there's a race to the bottom in user costs. If that takes place, then maybe PEs will come down, but it would not be because they're overvalued. It would be because these companies are no longer as profitable. That shift in thinking shifts how we view the market and could make one bullish about current markets. In fact, I'm bullish on current markets. I'm not a believer that big tech is in a bubble. And like I said before, that first chart we looked at, where we're at the same PE ratio that we were in 2000, well, that may be 2000's thinking. And I would hate to think about 2025 markets like someone from 25 years ago. If you made it this far in the video, you're one of 30% of people who do. And I know that you would like my weekly newsletter. I send out one email a week on Sundays with the goal of giving you a roundup of technology, business, economics, and market commentary and charts. Every issue is supposed to be engaging, light, and quick. And the goal is just to make you a smarter, more learned human with more context about the world. If that's interesting to you, check out the link in the description. See you next week.